Sir, could not, unfortunately, I could not attend last two lectures. Where can I found link for these lectures?
The link hasn't been sent over.
No, sir.
No. I will request Paresh keep kindly subscribe YSI office that the past link if you'll open now. So you have to just subscribe that channel YSI office. So you will get all the data of all the classes over there in live classes. Otherwise, I will provide last two. I think Shruti, please share from there. Either I will provide. Don't worry about it, sir. Yeah.
Okay, so that's settled.
Sir, it would be better if you share link of one lecture, because I changed my...
No problem. I will share. No problem. Today itself I will share.
Okay, thank you.
Okay. So thank you, Neeraj. So Neeraj will share the links. I would particularly ask you now to look at the video which we did last week. Last week's two videos, because I took, I think, at least 2 hours extra in equity. And one of the reasons for taking extra in equity was that I found in the beginning that maybe, what I want to explain to you, maybe I'm not being able to successfully do that. And I felt that maybe the understanding of equity is not exactly being built up. So, and my main concern was that if you go listen to the lecture and you come away with the feeling that equity investments are very risky, they should never be made, then in that case, that defeats the purpose. Now, on the other hand, if you get the impression that equity is something which we have to do, especially Shruti and people in her age group, equity is something we have to do simply because it's an easy way of earning money. Even that message is wrong. So I had suggested, based on what I have read recently, based on recent approaches to equity, on what you should try to do. And one message which comes very clearly, and which I am sure that those of you like Paresh ji or Praveen ji who may have small investments in equity, I hope you are doing this. Do not react to sudden ups and downs in the market. Do not be reactive. Try to plan your investment and stay there for some time. If you stay for a longer period of time, if you take companies which are genuinely good, I'm sure that you will do very well there. There won't be any problem. You should manage to make a good return. Certainly, you will make a better return than you make by putting your money in a fixed deposit. Even in mutual funds, I would say that if you go with something like an index fund, a good index fund, something which has been there for some time and which has a record of making good making good choices, you will find that over a 5-6 year period, even this will give you a safe return, a good return, definitely better than the fixed deposit. In equity, I had suggested that there were certain things which you should look at with respect to identifying the company. First of all, there was the fact whether the balance.
So your voice is not clear.
Voice is not clear?
Now it's okay.
Okay. So what I was saying is that as far as identifying companies are concerned, I had suggested that first of all, try to go for companies that have clean balance sheets. Now, how do you find companies with clean balance sheets? Basically, you are looking for companies where the promoters are outstanding people, where the promoters are actually reliable. Otherwise, you will find that there are various news items available if you look at, even if you check out YouTube or if you check out the web, where you will find that people are saying that as much as 80% of the companies that we have today are still not reliable in terms of the figures which they give us. That means, you see, whenever an auditor tells you that the figures that you have are not reliable, what he is basically saying is that you are bungling, you are cheating in some way, and you are basically diverting money from the company into your personal pockets. So remember, in the case of a limited liability company, it is a separate legal entity. So your personal bank balance and your legal individuality, your entity, your, let's say, identity as an individual, your Aadhaar card identity is very different from the identity of the company. So if the company promoters find very, nice, creative ways of taking money out of the company and putting it into their personal accounts, what will happen is they will grow very rich, but the company will remain poor. And if this happens, it is going to be very, very difficult for you as an investor to stay with such a company. So we can talk about this again at some later time. So I had specifically spoken about these things in that last video that we had. And that is basically what I am cautioning you against. There were other pointers there. Starting off with the clean balance sheet, there was something about something known as competitive advantage that was there. And apart from that, I'm sorry, my wife is there in the background. Okay. So I think she's decided to join the group in some other room. So I hope there will be no more disturbance. And so please have a look at those videos. And if at all there is something which anybody wants to take up with regard to equity in some later class, we can always discuss it. But today, what we have is something a little different. So the next unit that we have after equity was called alternate asset classes. Now, in alternate asset classes, what we are starting off with today is real estate investments. So when we speak about real estate investments, what do you think about?
Land.
Anyone? Okay, land. Okay, Shruti. So land, what land? Will you say that all land is the same? What land do you think you're speaking about when you say real estate investments? Okay, let's put it like this. If you just say land, can you divide land into more than one category?
Yes, sir.
Commercial.
Sorry.
Okay, Shruti, go ahead.
Commercial land for residential purpose.
Agriculture and non-agriculture?
Yes, yes. See, when you say land, you are basically saying this is about land on which there is no construction. So it is possible for you to think of real estate in terms of land alone, just land. And like Paresh ji says, it may be agricultural or it may be non-agricultural. For us, it will be urban. So that is one. So you think of that. Any other thoughts about this? Shruti, what you are basically saying is, you are saying, talking about a residential building and a commercial building. So a commercial building would be like a building in which there are shops or different establishments which have been set up for the purpose of business. And in the case of the residential building, basically it will be flats. Okay. So at least we have something. Is there any other form of real estate as investment that you can think of? Apart from, so let's say that we have land, agricultural, non-agricultural, we have commercial buildings and we have residential buildings. Is there anything else that you can think of here? Not so easy. Okay, fine. We'll get to that. Now, if you look at this tries to take the real estate sector and it divides them into residential, commercial, retail, hospitality, and SEZ. So these are the different types of investments which you can have. Now, the real estate sector itself is a huge employer. So it says that after agriculture, this sector is the next largest employer. So many people are involved in real estate. So if you work yourself from, let's say you start with the builder who made the flat, and you get into, the backward linkage, all the people who are involved, so that the flat could be constructed, the materials that were involved and everything, you will end up with, a figure which is equal to 6% of the GDP. And the main thing is, okay, let me ask you another question. Do you think it is a good investment?
Yes, sir.
Okay.
Yes.
Okay. So Paresh and G and Shruti saying very clearly yes. Why is it a good investment?
Its value only appreciates, and in most of the cases.
In most of the cases, the value only appreciates. So, okay, I think I agree with you. One of the drivers here, why does the value keep appreciating? And why does the value appreciate substantially? There you would say that urbanization. So there is a need for lots of land. There is a need for a lot of land in the country. And because of not land for the purpose of constructing buildings so that people can come and live, because the urban areas are expanding. So what land was formerly agriculture is being taken, is being absorbed into urban areas. So as these lands get absorbed, their value appreciates because it then becomes part of the corporation area. It has better civic facilities. More and more people begin to come and live there. They pay more taxes, and ultimately the value of that particular area increases. Okay, so that is one. The hospitality part here will, of course, refer to the hotel industry, basically. Hotels, resorts, that part. So some people make investments here also, commercial, like you said, and the special economic zones. This is, of course, something which is technically there, that this is also a chance for, it's basically a commercial investment. That's all. So these are some of the parts to it. There is this report, which I find very interesting. So this report is an old one. So it came in 24th August 2017. But broadly speaking, it will still give you a broad idea about exactly what the real estate sector contributes. And you find that 77% of household assets, HH is household assets, is allocated in real estate. That means most people, they own some property, and this is normally the biggest investment that they have. So even though when we speak about assets, financial assets, we first think of things like equity and debt, mutual funds, bank deposits, government securities, etc. The fact is that the largest investments are made in household assets. Now, in the case of India, as you can see, it is 77%. If you look at this dark blue, this little rectangle here, you can see that India has 77, China has about 60, Thailand has, I think this will be around 50, USA has around 40, UK is maybe also around 40, Australia has a little more, around 50, and Germany has around 40. So basically, in India, we seem to have the highest allocation in household assets, which is basically real estate. So that's one thing to think about. This is a 5-year-old report, but things may not have changed. That's one thing. Then, why has there been a slowdown in real estate in the past 4 years? One very clear, I'm sure you people see the relationship between demonetization and GST and how these things contribute to a slowdown in real estate sales. Anyone? Why would demonetization and GST lead to a slowdown? Pareshji, you know the answer to this. Shruti?
Sir, because most of the businessmen used to buy land from their black money.
Okay, chalo, you're very, very clear about this. Great. So, yes, Pareshji?
Yeah, same answer. I agree with Shruti.
You agree with that. And what about GST? Same thing.
Same thing, sir.
GST
Now it's compulsory, so it's very difficult.
It's difficult. Huh? So it took some time for the builders to, adjust to this new reality. And then, so that led to the slowdown. And because of that, high property prices have turned end users into fence sitters in most markets. So what has also happened is that because the prices of flats are very high, or any property for that matter, is very high, because of that, people who actually use the flat or the commercial property, they have also slowed down in buying these things. They have slowed the pace. That's another reason. Participation of the investor community has reduced significantly on account of falling returns on the asset class. Now, the slowdown has led to, let's say, lower returns for investors, and that in turn has led to a, let's say, see, if you don't sell, you don't make profits, you are unable to pay your investors. If you are unable to pay your investors, you are unable to convince them to make fresh investments. So when they begin to pull back the funds, that will also lead to a reduction. So basically, we will just note this, that there has been a certain slowdown in real estate. Those of us who have been interested in buying property during this period, we know that the slowdown actually resulted in a reduction in property prices for a short while after the lockdown particularly and demonetization. Okay, so this is one. If things go well, you can make money like this. So the price in May 2013 for a villa in Bangalore with 1800 per square feet land, built up area 2000, the cost of land is 1800 per square feet. The built up area is 2000 per square feet. The purchase price of a villa was about 84 lakhs. This was in 2013. Now, if you come to from 2013 to 2020, the price moves from 84 lakhs to 2 crore 20 lakhs. So this is just one example taking a bigger investment, a villa, but more or less, you will find something similar happening in this period. But what we need to understand is that this is not something which is, this pace has not continued. There has been a definite slowdown. So 136 lakhs in 7 years. So the compounded annual growth rate is 14.7%. So almost 15% return you were able to get for 7 years. And so if somebody had bought at the prices in May 2013, waited for 7 years, he would have got a good return of 15%. Now, when we look at this, so this gives the story of, I think, most of the towns in India. The Bangalore city is growing. So this, instead of Bangalore, think of any city which is growing. The basic demand supply equations will remain the same. There will be a demand for flats. that will lead to a demand for land, that will push up the land prices, that will in turn push up the prices of the flats. So those people who bought earlier will be at an advantage, and therefore it becomes a good investment. That is one. The other aspect, of course, is that the areas are becoming more developed. Each area. Now, this again, I think applies across towns. It is not just Bangalore. Many towns in India, you will find that the areas are getting much more developed. They have better facilities in terms of connectivity, in terms of schools and colleges, malls, whatever facilities you want, those things are definitely increasing. So because of that, there has been a boom. So normally when we think of real estate, when we think that this is a very good investment, this is one of the reasons why we think it is. It is very good. But in my mind, there is one thing which you should, since we are doing this course on financial planning, you look at this, you're very impressed, you feel that this has done excellently. But remember one thing which we just saw out here, and that is that just 1 minute. The compounded annual growth rate was 14.7%. So you bought the land, you kept it with you for 7 years. After 7 years, you decided to sell it. You found a buyer. So there is the process of finding a buyer. It is not immediately sold. And then if everything went well, you were able to sell it for this 220 lakhs. You make a profit of 136 lakhs. And you say that my return is 14.7%. But I would just like you to think about one more thing, that there are many index funds. There are many equity investments which would have got you the same return with excellent liquidity and less problems. So when we say that this is a very good investment, I don't doubt that, but please don't think that this is very much better than something else. That is one thought I just want to put in your mind. Then, why do we invest in real estate? Basically, it is the same thing. India is urbanizing. The urban population is expected to increase hugely. As the urban population increases, there will definitely be a need for more and more flats for residences, which in turn will lead to an appreciation. Population is also going to increase. So this whole thing, it will lead to more and more demand. What is the normal thought which you should have? If you get into real estate, you should hold on for about 10 years. If you can keep that land or the flat or whatever it is for 10 years, 10-year lock-in, you will come out with a very good investment, with a very good return. Now, this is exactly what we say for equity also. If I get a very good company, and if I hold, or if I get a selection of good companies, I hold on to those investments for 10 years, then I can make a seriously good money. In many cases, you will probably make a better return than you make here. I can think of very many 10-year periods between, let's say, 2000 and 2020, 2000 to 2010, 2011 to 2001 to 2011, where an investment made in the earlier period for 10 years in a good set of companies would have got you a return which probably may have beaten even this. So keep the alternative in mind. The opportunity cost, keep that in mind always. This is very good, okay, but if I am beginning to think like a good financial planner, basically like a finance person, then I should be looking at the alternative also. That is the point I'm basically trying to make here. Now, note this main thing here, that even in real estate, it is a long-term investment. And remember one more thing in real estate, it is a lump sum investment. You do not invest in parts. You invest lump sum. If you had the money If you had the money entirely on your own, that's one way of investing. Or you put up some part of the money of the cost of the flat. The rest of it you took as a loan. So in one way or the other, you will have to arrange for the entire amount, and only then is it possible for you to actually invest. So that is one point. Then in India, given a decade timeline, urban real estate plays on the demand supply gap and hence gives inflation plus returns. That's one. So it is difficult to find a good stock that will be a tomorrow winner, but it is comparatively easier to find a good real estate investment. But it is also true that it is not that difficult to get a selection of good companies who are consistently doing well based on their past performance, based on the sort of market they have. This is where I want you to look at that the section on equity. You may find that even though this point is made here I am favoring real estate, so I've written this. But even then, I would say that this may not always be true. It is possible, I think, to get one good stock, maybe there is a problem. But a range of good stocks, some of which will definitely do well, I'm sure you'll be able to find something like that. Okay. The next thing it says is that real estate is less volatile than stocks. So basically, this will be the way a person who wants to sell real estate to you, this is what he's going to say. Okay, real estate is less volatile than stocks. The transition towards a correction or boom takes place gradually, giving ample time for investors to read the transition. But unlike stocks, they cannot safeguard their positions, as real estate investments are chunky and you cannot exit in a hurry. So that is the problem here. See, it may be less volatile, but the problem is that the market itself constricts or becomes smaller whenever you are at in the downward part of the economic cycle. When the economy is booming, when everybody has jobs, people are earning money, they are thinking of the future in a very optimistic way. At that point of time, you will find that people are very happy to buy a flat, take loans, do whatever it takes, but get that flat. But as the economy gets into a downward spiral, people will not be there who will buy your flat. That is one very big problem. I can give you a personal example here. When I first came to Pune, I began living in a rented apartment. Now, this particular person who had the owner of the apartment, he was a high net worth individual. He was in fact making a lot of money in the US as an investment banker in the US. He used to work for Goldman Sachs, was making a lot of money. And every time he had a substantial amount of money, what he would do is he would take that money and he would invest it in a flat in Pune and hope that over a period of time, he will get a very high return. Now, what happened was, in this particular flat, I think for the last, maybe it was a 5-year-old flat, as far as I can recall. It was a 5-year-old flat. I was the second person who came and rented the flat. And he had bought the flat, I think, for somewhere in the range of 60 to 65 lakhs at that point of time. The location was reasonably good. It was essentially 2 big rooms and one, something like a half room. It could be used as a study or as a puja space, something like that. And then he decided after 5 years to sell that flat because he felt he needed the money to buy a big villa. He had some savings of his own. There was a shortfall. So he said, why don't I sell this flat, use this plus whatever savings I have and invest in a villa. When he sold the flat, he sold it for hardly 5 or 6 lakhs more than he had bought it after 5 years. Now, given the interest rates in a bank at that point of time, so we are talking about the interest rates in 2010-11, it was close to 10% in those days. So his return in this investment was actually less than he would have got in a simple fixed deposit. The point I'm making to you is that real estate is fine. It is a good investment. It is less volatile. But there is again this particular qualification that you should be able to buy when prices are low and sell when prices are high. If you do the reverse, it is going to be a problem. And the same principle is there in equity also. In fact, to some extent, the same principle is even there in a mutual fund. Your timing, your entry timing is crucial. If you invest at a point of time when the stock or the mutual fund NAV or the real estate prices are at a lower, it's basically trending lower, then you are going to make a profit sometime in the future. This is one lesson. The second lesson, of course, is that whenever it is sold, it has to be sold after a long period of time if you really want to make some money. So this is one. Yes.
So one point from my side, if we purchase flat or land, whatever it may be, on loan basis, then if we compare returns against the loan and interest we are paying, I think we hardly get 1 or 2% return.
There you are. That is another thing. See, that I'll show you today what happens in outside countries where the rental income which you get is so high that you are able to take, actually do very well with your investment, which is not possible in India, because considering the amount, the flat costs, the rent which you get is very low. For 1 crore you buy a flat. What is the rent you are getting? You are getting 15 to 20,000, which is nothing. So that is one very, very serious problem out here. And you are paying interest to the bank. It may be a floating interest loan. It is possible that you will pay more interest in the future than you are paying today. It can create, a very, very, what shall I say, a disappointing situation in the future. Now, the problems in real estate investment is exactly what I was telling you. The low on volatility is clear, but it is also low on liquidity. In the sense that when I want to sell, if I do not find a buyer, so this is not like the stock market where I place a sell order and it is sold immediately. It's not like that now. It is only going to be sold if you manage to find a buyer who is willing to pay the price that you want. So that is one big problem. Like it says, if you want to exit a real estate investment in a hurry, you cannot without losing money. In the example I gave you, this person was selling it after 5 years. So you can't really say he was in a hurry. He waited for 5 years. Even then, he found that he could hardly make any money. Okay. So real estate investments need large capital allocations, typically rupees 35 lakhs and above for a metro and rupees 20 lakhs and above for other cities. And please note, this 35 lakhs and 20 lakhs which he's speaking about is only the down payment amount. You will not get the complete flat for this price. Apart from this, there will also be a certain amount of loan which will be involved. So that is another thing to think about. And of course, there is this problem, which I think is something which I think has greatly reduced. The real estate has been traditionally used as a place to park black money. One of the things here was that builders were always willing to accept payments in cash. So it was very easy for someone with money which was unaccounted for to actually simply take the cash and transfer it to the builder and in return receive a property. Okay, so that's one. Then, if we look at other key problems here, we find that almost 90% of our lands do not have a clear title. Legal litigations go on for years. This is something personally I can identify with, because today I have an investment in a disputed property. It was not disputed when the investment was made. The dispute came after the investment was made. So there are farmers from whom the land is acquired. This is in the Gurgaon area of Delhi. The builder gets the plans passed. Then people invest. Thousands and thousands of people invest. Then the farmers begin to say that we will not allow you to build. A case starts. This case, you will be amazed to know, has gone up to the Supreme Court. And the Supreme Court is unable to get the state government to enforce the rights of the property owners. So this particular point here is very, very, very crucial. You will have to buy property which is absolutely clear in title. And sometimes, despite the legal opinions which are there, despite what people are saying, the land that you invest in is actually not that clear as far as title is concerned. Then, of course, the stamp duties are very high. That is 10% basically means if it is a 50 lakh flat, you are paying almost 5 lakhs in terms of stamp duty. That is an additional burden that you have. And of course, rental laws need revision to protect the owner from tenants. This is one. So overall, there are risks in this sector that cannot be quantified easily. This is, I think, very correct. So like in the case of other clear-cut financial investments, you know, if there is a risk, it is generally possible to quantify the risk, that this is what will happen in terms of actual money. In the case of real estate, you just don't know, because if things go bad, if things, let's say the area gets into dispute, the value of the land goes from whatever it was to zero. Because once it gets disputed, it cannot be sold. So these are some real problems which are there. So that's one. Wealth management firms do not offer services in this real estate due to the above mentioned problems. So for example, when we were looking at our earlier chapter on wealth management, we told you that there are firms, there are banks which offer you various wealth management services. They build up portfolios for you. But normally these people will not touch the real estate side. And the reason for that is this, that there can be unforeseen problems which will maybe create problems for the investor, and that will bring the person who recommended the investment into disrepute. So that is one point to always remember here. And now let's just go here to what are the investment options here. So residential properties, flats, landed residential property. So the way our parents built their houses, they bought a plot of land, they got someone to design the house for them, and then they got it built locally. So houses with land. Commercial properties, shops and offices. Land itself, your commercial, industrial, residential. Land which is meant for commercial development, land which is meant for industrial development. This industrial development part would be, commercial development part could be land which is later on used for an SEZ. That's one example. Land which will later on be used for residential. But right now it is just land. So that is also an investment. And finally, there is land which is agriculture. This is the question I had asked in the beginning, which you people had answered correctly. So this is one. And the last one, which I think you will find very interesting, is the Real Estate Investment Trust, REIT, which we will cover towards the end of today's session as we complete this particular chapter. So let's start real estate stocks, of course. That is not something which we really want to get into. So let's take this first, residential properties, flats. So typically one buys an apartment 3 times the annual salary. So this is one thought is it possible today to buy an apartment which is 3 times your salary? How do you react to this? Paresh ji?
What was the question, sir?
This one, if you look at the presentation,
Yeah.
typically one buys an apartment which is 3 times the annual salary. So if the annual salary is 10 lakhs, what he is saying is that you are buying an apartment which is about 30 lakhs.
30 lakhs. Because, sir, banks also have limitation to give loan.
Okay.
So
you are saying that apart from the 3 times, there will be a certain amount of loan which will have to be taken. Is this what you are saying?
no, no. What I want to say that yes, I agree with this statement. Generally, it happens. We purchase range only.
Okay, fine. Now look at this. These apartments typically give you 2 to 3% annual rental return. That means if you have a 50 lakh flat, your annual return on that 50 lakh flat will be in the range of about 1 lakh to 1.5 lakhs. Think of it like this. And this will happen, basically you take that amount, you divide it by 12, and you think of the amount of rent which you will get. The normal thinking is that whatever is the cost of the flat, but of course, the rent which you get is about 3% of the cost of the flat. If you are lucky, you'll get something more than this. But I don't think under any circumstances you will get more than 5% of whatever is the cost of the flat. Which basically means that, so if you had taken this money, the same amount of money, and you had invested it, let's say, in some other financial asset, would you have got only 2-3% or would you have got more? That is one question. But of course, there are other issues here also. It's not that simple. The capital appreciation can be between 0 and 15% per annum. Right now, it is closer to 3%. So this particular slide is something which I made during the lockdown. So at that point of time, this was considered to be the amount of appreciation in the actual capital appreciation.
But I think still it is same, sir.
Exactly. That is the point. That is the sad thing here. That I would say that people who have bought real estate and who are living in that particular flat, they are okay. They are at least saving on the rent part. But if somebody has made an investment in some other place, has been transferred because of his job to some different place, he's paying rent there, he's getting rent here, then I don't know whether he's gaining anything or not. It's very difficult to judge that. And maybe at the end of the day, he finds that even paying the installments is a hassle. So there are lots of things to consider here. Look at this one. So one calculation. If you take flat for 50 lakhs with housing loan, 20% will be from your side and 80% will be a loan. Shruti and Tanya, are you understanding this here? Because I'm sure Paresh ji and Praveen ji are very clear about what is being said out here. Shruti?
Yes, sir.
What does it mean?
When we have to take flat with help of housing loan, then 20% of this 50 lakhs we have to pay that, and the remaining 80% will be financed by the loan.
So how much will the bank give you?
40 lakhs.
40 lakhs. Here you are. So 10 lakhs from your side, 40 lakhs from housing. Tanya, did you understand this?
Okay.
Yes.
Sir, actually today I'm not properly attending my class because, sir, I have fever. So, sir, I have a bit of problem.
Okay, Tanya, fine. It's fine. It's okay. Just listen. If you can find the energy to do that, just listen to what we are saying, to what we are discussing. That itself will help. Okay. Then, assuming the loan has a 15-year repayment period, your EMI would be approximately 40,000 per month. So if you are taking that loan, that housing loan, your biggest challenge is that you will have to make sure that this additional monthly expenditure of 40,000, this is something you are prepared to handle. This is your first big challenge here. So the example was considering a particular property which will be constructed over a 2-year period. So why this? Why not a completed property? Because the completed property is generally very costly. So if you want to save some money, probably it is better to buy something where the builder is reputable, has a good track record of completing projects on time. If you enter at the early stages, then normally you tend to pay less. Once it is complete, then the prices immediately go up. So that's one thing. Registration of home and interiors would cost approximately 10 lakhs. So what he's saying is that suppose you assume that 50 lakhs is the cost, 10% is the stamp duty. So 5 lakhs is going for stamp duty and 5 lakhs is basically going on interior decoration. So you will get a flat which has nothing. So you will have to basically furnish the flat in every way, equip it with furniture, the electric connections have to be done. There's so many things which are there. The kitchen has to be built. Lots of things are there to consider. If the builder provides those things to you, probably he will increase the cost. So many things to think about there. The rental for a flat would approximately be 10 to 15,000 per month. So basically, if it is 15,000, you're making 180 per month on an investment of 15 lakhs. What percentage is that? Shruti, just find the exact percentage, please. 50 lakhs, and basically you are getting, let's say, 1.80 lakhs. What is the amount? What is the percentage return?
%3.6%.
3.6%. It's possible that you may not get 15, in which case it is going to be about 3%. That is why the normal conception is that you get 3% of the, or close to 3% of the actual cost, which is a very low return when we consider the return people are getting in the foreign countries. Okay. Now, continuing with this, so you should, for those of you who will start very soon, or the idea is that buy the flat in your initial few years. So I recommend that you do not buy a very small apartment. Okay. Typically, these apartments are budget apartments, and the kind of tenants you will get are high maintenance tenants. Remember this. So budget apartments means you get tenants of the same quality. So people who may not actually be very, very protective about your property, they may not keep it very nicely. So it's possible that every time they are there, they damage things. So this is actually a fact. If the flats are generally given to better quality tenants, you get a better rent also, and later on you find it is easier to get the flat back into shape. That is there. So they may give you a decent capital appreciation, but most such apartment complexes have a very large number of apartments. So there is high competition, as there will always be other owners who are selling too. That means that if there are, let's say, 50 or 100 units in that apartment building, in the whole building, then what will happen is that at any point of time, if somebody wants to sell, he is already competing with 1 or 2 more people who are also wanting. Because there are always some people who want to sell in a hurry. And when somebody is there who wants to sell in a hurry, he is always willing to accept a lower price. So you may not be selling in a hurry. Maybe you have waited for your 10 years. Despite that, it will be hard to convince a buyer to buy your flat if somebody else is selling something for a little lower. So that Risk is always there. Then let's look at the other side. Residential properties, houses with land. Here, of course, the upfront investment is going to be very high. So this will probably not be suitable for most of us. It's very difficult to actually get into this. So here also, those who have, at least a little more money and are willing to take this particular option, the advice there would be to buy land in the outskirts where the value today is low. And then there is a greater chance of appreciation. In fact, this is in Pune particularly, I have seen this, that even people who are not very wealthy, but they take this, huge, they invest in lands which are, let's say, a few kilometers away from the city, hoping that the city will reach that place. And at that point of time, their land will appreciate in value. So once again, this is the gamble. Those people who have, they will talk to the corporation people, they will talk to politicians, and they will try to understand how this city will expand. And if they begin to get an idea that the city is going to expand in a particular direction, and then in that case, they will buy land that side. And obviously at that time it is agricultural land, so they buy it at a cheaper rate. And then they wait, and when the city reaches there, there is a huge appreciation. If the city doesn't reach there, then of course, their appreciation will be very low, and they will again have to sell it as agricultural land itself. Okay, so typically land rentals, rentals are 2% lower than apartments. Like I keep telling you people, I live in Lavasa, so there are lots of villas there. And I can vouch for this personally, that a person investing in a villa, if he wants to actually put this out on rent, he is not getting something which is substantially higher than the person who invested in a flat. Even though the capital cost for the villa was much more than the capital cost for the flat. So this is again something which you should try to just keep in your mind, as something to remember. If I buy a flat, the rent that I get, the annual return is about 3 to 4% at the most. Could be lower than 3 also. If you buy a villa with land, then the annual return is sometimes only 2%. Annual return meaning the total of 12 months rent divided by the actual cost of the villa or flat multiplied by 100. So that is very low. That's one. And okay, so this we've already covered. Banks give loans and all that. That is there. So the recommendation here, if you are investing for investment's sake, just buy the land, fence it, and leave it. Do not construct the house. That is always good policy to follow. If that sort of money is available with you, you feel that it's possible for you to buy. Sometimes in the smaller centers in India, this is sometimes an option, provided that there is a belief that there is safety. Nobody will take over the land, etc. So land is not that simple. So after 5-10 years, you sell it, you should get 15% per annum appreciation. That is the normal thought. If you are investing with a view to live, then think 10 years of living and design the house. Do not try to optimize. Okay, fine. That's one. Now you come to commercial properties. Now this is something which you normally don't think about. This is something which even high net worth individuals don't actually consider immediately. Like for example, when I told you about my landlord in Pune, that gentleman there sitting in the US was very comfortable buying residential flats, but he was not considering the other option, the commercial flat option, the commercial office option, where possibly it would have been easier for him to sell, and he may have even got a better appreciation. Typical investment starts at rupees 150 lakhs, and rentals are around 7 to 10% of the invested amount from year 2. So after 2 years, what the amount of rent that you get on a commercial property, that total rent is about 7 to 10% of your investment, which is much, much better than the 3% that you own on in residential properties. It's just something to keep in mind. Capital appreciation is also about 5% per annum. The total return on investment of 12 to 15% per annum. How is he coming to 12 to 15? Basically, he's taking, let's say, like you take 7% of rental plus 5% per annum capital appreciation, that will give you 12. If your rentals are higher and you're getting 10%, then 10% of the rental plus 5%, that gives you 15%. So you will actually be getting 15% in commercial property. Catch, of course, is you should find a good commercial property and you should have money of this kind. The other problem here as far as loans are concerned is that it will be much, much more difficult to get a loan against commercial property, and the interest rates will also be higher. So that's something which you have to consider. So urban land, this is the land part. Land used to be a fantastic option. There's no doubt about this. So here I wrote this. This will apply only to, this was written basically for college students. So I mentioned this. In 1999, if your father invested 6 lakhs and bought a piece of land in any urban area in India, it is likely to be worth 100 lakhs today, 15% CAGR. Once again, there are certain things to remember here. This is not always the case, but this could have happened in this period. This 1999 to 2016-17 period, yes, this could have happened. It's possible that we could have gone from 6 to 100. This particular level, this momentum of growth is no longer possible in most areas. That's one. Many families buy a piece of land when a kid is born. After 20 years, this investment can pay for the kid's education or wedding. So one thing which comes again and again, whether we are thinking in terms of buying a flat, whether we are thinking in terms of buying residential land, house and land, or whether it is commercial land, in each case, the returns only come if you stay invested for a particularly long period of time. Can we take a short break, guys? 5
Yes,
minutes?
sir.
And okay, and I'll be back after that. Thank you. Okay, Pareshji and Shruti, you're there, no?
Yes, sir.
Fine. So I'll continue with this. So we were just saying that an investment in land in an urban area used to be remarkably profitable. And in this period, as you notice, when I say that if your father had invested 6 lakhs, it was possible to do this. It was possible to make an investment of this size in 1999 and then reap the benefit many, many years later. It was also possible for some families in those days to actually do what is written here, buying a piece of land when a child is born and then selling that land many, many years later to get the benefit of appreciation. So this used to be possible. It will not be possible always, in the days to come everywhere. So this was one point. The other points here is the land investments don't give any cash flow, remember. And they can be difficult to exit, but they give superior returns. So basically, it's the same thing. They may be low on volatility, they may be low on liquidity, but if you are able to, if you have the patience, they will give you a good return. If you compare with equity, good company, more or less the basic principle remains the same. With one major difference, in equity, there is liquidity. In equity, there will definitely be volatility, but there is liquidity. Here, there is no, the liquidity is low, volatility is very low. So one, you gain somewhere, you lose somewhere. That's one point. Typical investment starts at 20 lakhs, value doubles every 4 to 5 years. But you have to stay with it. Now, there are risks here about clear titles, and hence one needs to invest with caution after taking good legal advice, which I have found is sometimes inadequate. So even when you get good legal advice, sometimes it is not possible to actually get the best out of it. Then lower value investment starts at 5 lakhs, but the initial appreciation takes 5 to 8 years. So by and large, the principle here is that if you want to lock in a very small amount, this 5 lakh type, you will basically be doing it at a little distance from the settled urban area in the town, which basically means you have to give the town time to expand and reach the place where you bought your plot. And only then will the value actually appreciate. So even now, it is okay to buy land as an investment. This is my last point here, even despite all this. But please remember the point regarding liquidity, and the fact that it is not easy to exit this investment when things are not so good. Once, if things begin to really pick up, yes, you will get a number of people who are there, who want to take it up. Agricultural, in many states, there are restrictions on buying farmland. So that may actually create problems for you. If you are qualified to buy farmland, it makes sense to buy agricultural land approximately 5 to 7 kilometers from the outskirts of any town. Build a farmhouse and wait for the town to grow to your property in 15 to 20 years. So this is the same sort of same idea which I was telling you a little earlier. In many towns, like for example, if you take Pune, if you go to an area which is 5 to 7 kilometers away from the main town, you will find that the villagers there are remarkably good with understanding property development, and whatever money is to be made in the deal they will make, because they will already sell it to you at a very high price. So you have a very good marketing campaign happening in the Pune area, where they say that land available for farmhouses. Exactly this, what we are saying here, exactly these words are there you will find this written on placards on the highway as you pass the village: land available for farmhouse. And you can bet that if the villager understands this basic dynamic of prices so well that he writes land available for farmhouse, then the charge is going to be pretty steep. So a lot of the profit that you could have made using this technique will disappear because the villager himself is more aware of this. So, okay, if you are actually lucky here, it will give you a good return. You will again have to be clear about titles, etc. Only then will you do it. Now look at this. This is something which I thought which might interest you. You look at the returns in US or Europe. So this is a screenshot from the website of a property developer in the UK called Rightmove. And these are some of the properties which the person is showing. And what he says is that the purchase price is 80,000 pounds. The rent which you will get if you buy this property and rent it out, the rent that you are likely to get is going to be about 525 pounds per month. Now, look at how this works out. So you put 20% of the value, 20% of 80,000 pounds, 16,000 pounds you put up, 64,000 pounds, take a home loan, 3% interest only on the loan. So the advantage abroad is that the cost of capital, as we discussed, is low. So you get the loan for about 3%. So you get your loan of 64,000 pounds for 3%. You put up 16,000 pounds yourself, 64 plus 16, 80,000 pounds, you buy the house. The rental income will be 6,300 pounds per annum, 525 into 12, 525 pounds per month multiplied by 12. Interest outflow for this will be 1,920 pounds per year. Okay. So by investing 16,000 pounds, you make approximately 4,380 pounds per year, 27.4% returns. And what is it in India, Shruti? What is the comparative figure which we spoke about in India?
3%.
3%. So this is the main issue abroad. So if anybody gets a job and he goes abroad, he finds out very quickly that a large part of the salary that he earns or she earns goes into paying the rent on the flat which they take up. Whichever flat they rent, a good amount of it goes into, the salary goes into paying the landlord. So this is why this real estate as an investment abroad is generally a very good idea. Not so good here. If you use this model here, instead of 27, you're getting 3 only. So just something to think about. What are the do's and don'ts here? So the return on interest on real estate investments is very dependent on the location. In good locations, you get a good return on investment. Fortunately, with massive urbanization, all cities in India offer good locations. But all cities also have bad locations. Let us remember that part also. All cities also have locations which are not so good, but which are available. So if you choose wrongly, you can land up in trouble. One advice which I have personally applied this to my own life, so I can say honestly that when I'm giving you this advice, it is what I have done myself. So when you buy real estate, don't involve your emotions in it. Think of it in the same way as you think of equity. Think of it as something which is an investment. Your entire strategy should be along those lines. Where you will live when you grow old, that is a decision which you can take based on the liquidity that you have and the resources that you have at that point of time. You should have some property. Whether you will actually stay with that property, that is a different thing. That investment can always be switched. This is what I have personally done. It is not the most popular model, but it makes a lot of sense because when you stay on rent, sometimes it is cheaper. Okay. This is absolutely critical. You must have a good lawyer who is involved in the sale agreement so that your interests are protected. only then is it possible for you to actually be safe here. Registration of the agreement and getting the documents converted to your name. Mostly you will find that advocates now they have their own contacts in the registry offices, and they actually help you to do this properly. And do not buy property if the documents are not clean, as it is difficult to sell later. I am already a victim of this, though I thought it was clean. And the best part is that many banks had got their advocates to vet that particular property, and all the advocates had said that it is good, clean land. And despite that, it ended up in trouble. So this part is a genuine big problem here, which we should remember. Now we come to what, to my mind, will be your major takeaway from today's class. And this is real estate investment trusts. So real estate investment trusts are like open-ended mutual funds where individuals can invest minimum rupees 15,000. The real estate investment trust manager will use the funds to own commercial properties and get rental income or income from selling the property. Okay, let's try to, first of all, let me just ask you, have you heard of this? Anyone?
No, sir.
Okay. Shruti?
No, sir.
So that's why I said that this concept of an REIT is something which I have been reading about this for some time, but it is actually only in, I think, 2019 that the first REIT basically came. So a real estate investment trust is basically, think of it like this. Today, if we have, let's say that there is someone who is a builder and they want money to start a project. They want to become big builders. They want to invest in land and have different projects. If they want to do that, then normally they find people on a one-to-one basis, try to get people to invest. Their major source of money are individuals and to some extent some borrowing, but mostly it is different individuals who are willing to give them money, who are willing to take the risk. Now, what happens here is that suppose a real estate investment trust comes and it comes out with something like a public offer, and people buy. These real estate investment trusts are able to then take that money and use it for the development of commercial real estate or residential real estate. In the process, what is happening is that the building industry is getting another source of funds. Now, what they do basically is that initially the builder was taking money from a certain number of high net worth individuals. But if I say that I will sell this as shares and the minimum investment here will be 15,000. This used to be 2 lakhs. It's only very recently in the last 6 months or so that RBI has allowed this to be reduced to 15,000 per individual. So one individual can invest a minimum of 15,000 in buying let's say a share in this sort of a real estate investment trust. The money which the fund manager gets, he takes that and he invests that in commercial property. And then when he invests it in commercial property, from there, whatever income that he gets, that income he gives to you as your, that is like a dividend for you. Are you getting the idea? Both of you?
Yes, sir.
See, normally when you buy share in a company, the company takes that, uses the money for its own particular productive activities, generates an income from that, makes profits, and they give you a dividend. Here also, it's the same thing. The difference is that they're taking the money and they are investing in real estate. From the rental income that they get, they are giving you 90% of that income. Now, there are certain rules which go beyond the mutual fund. So we are saying that it is like an open-ended mutual fund, but there are certain rules which go beyond that. And these are, the REITs can raise funds through an IPO with a minimum size of 500 crores. So the size is going to be big. 500 crores of investment has to be there. They will come out with this. At least 25% of this must be offered to the public. That means 75% can go to bigger investors. These can be institutional investors, they can be pension funds, they can be anybody with, let's say, a certain amount, a big amount of money. So it will go there. You are already aware that even companies which come out with their own IPOs, only a certain part of the money of the shares that are there are available to the retail investors. The rest goes for institutional. So more or less nothing new. The same thing is here. Only point here is that 25% of this has to go to the public. So if you or me were to buy these shares, we will buy from this 25% here. That's one. Then each RIT must have 80% of its fund in completed properties, ready and revenue gathering. Basically, that means that each real estate, suppose they make this IPO, they get 500 crores. Now this 500 crores has to be used. 400 crores has to be invested in a completed property. Because why completed property? What is the relevance here? The answer is on this page itself.
About revenue gathering, immediate returns.
Yes, because if the property is not completed, then they will have to wait for the property to be completed, and only after it is completed will it be possible for them to get some rental income. So the rule says that they will have to take the money and invest in a completed property. That's the first part. Now, they can go up to 60% in one property. So essentially, they will have to buy at least 2 properties, because out of this 80, 60% can go into one completed property. The other 20% will go into some other completed property. Or you can do it 40-40, whatever ratio you want, but you should not put more than 60% in one property. Why do you think this is there, this rule? So think of it as a way of diversification. So if they put the entire 80% in one property, and that builder turns out to not do such a good job, or maybe the rental incomes in that area are not so good, then they will they will get a smaller return. But if they have 2 properties, then at least it is possible for them that if one doesn't do so well, the other will do well. So it's a form of diversification basically. Now 80% is gone. The other 20% can be used to buy underdeveloped properties. There also there is a restriction. Don't put more than 10% in one. Or it can be used to give loans to builders, or they can invest it in any money market security. That means in any government security. So that means 100 rupees, let's say for every 100 rupees, 80 rupees they will put in completed properties. Out of that 80, 60 rupees will go into, let's say, one particular property maximum. The other 20 will go into the second one, or in any ratio they want. Other 20 which is left, that they can use to give loans to builders. So like I was telling you, that this real estate investment trust is opening up a new source of funding for the builder. This is how it will work. So this 20% of 500 crores, let's say that 500 crores is the amount of issue. So 20% of 500 crores is how much? 100 crores. So 100 crores are now available and they can give this as a loan to the builder. So that is one point. Or if they don't want to give it as a loan to the builder, it is possible for them to take this and give it and buy, let's say, a government security, and where they will get that 7-8% return, but at least it will be 100% safe. So the thing is, if they cannot find a good place to invest for the moment, temporarily, they can park that money in a government security, which I told you when we were discussing this, that there is complete liquidity in government securities. You will always find a banker or some institution who is ready to buy that government security in the money market. So that will make it easier for you to sell. Then they must distribute 90% of the income. So they can't reinvest it. So for example, like when we speak about companies and we say that the profits that they get, they can reinvest the entire profits. There is no compulsion on them to give you any dividend. That is not the case here. Here, whatever rental income they get or whatever income they get, basically the entire income, 90% of that has to be given to the investors, to people like you and me who invested in the RIT. The other 10% can be retained for some other work. If they sell, suppose they sell the property that they had bought. Remember, they had used the property to buy, use the money to buy completed properties. Now, if they want to sell that property, whatever money comes from there, that must be distributed. That money has to be distributed again. So that is another point. Now, the sponsors of the REIT will need to own 25% of the project for 3 years after listing and 15% then on. So it is not possible for a promoter to simply come out with a public offering, sell the shares and not be, invested himself. He will have to have a 25% investment, 25% of the shares, basically he will have to own for at least 3 years. After that, he can begin to divest those shares in the market. Did you understand this part? Shruti?
Yes.
Okay,
Yes.
Pareshji. Shruti, you got this?
Yes, sir.
Okay. So REITs must get their properties valued every year and declare their NAV within 15 days. So basically, based on the valuation of the property, they will have to declare what the NAV is. So if you want to sell the shares back to the REIT, it will be based on the NAV, and the NAV itself is based on the value of the property. So if the property prices are going up and it is appreciating, then the NAV will also be going higher. That is the yes.
So sir, in our REIT, we will get our capital investment back.
But it will be a secondary sale. No? It will be a secondary sale because it is open-ended, remember?
Yeah. But it is not a mutual fund. We can sell it at any time, or it will take time.
You can sell it anytime. You can sell it anytime.
Okay.
You can sell it anytime. So this point which you are making, from what reading, because there is not too much material available on this, but from what I understand, it is possible for you to sell it back to the mutual fund also, to the REIT also. It is possible for you to do that. So that is what I think that we can more or less assume that whatever price is being quoted of the share, you can probably sell it back to the REIT for that amount. Whatever. If so, there I'll show you, there is a screenshot of one REIT in India, Embassy Office Parks. They are the first REIT. Now they have 2 projects. So it is selling at 340 rupees per share. So if you want those people who had bought shares in that particular REIT, they will sell it at that particular NAV of 340. The rental income is not taxed at REIT level, but investors will need to pay the tax. So this used to be another what shall I say, issue with the success of REITs. So the income tax department, who is always more than willing to tax everyone, that is their job basically. So it's okay. They apparently in the beginning, the proposal was that they would tax the REIT at also. For example, the REIT gets an income, they will pay tax. Then they will distribute that income to you, then you will pay tax. So it was like a double taxation thing. But right now what is happening is that the REIT, for the rental income that they get, they are not paying any tax. They will simply get the rental income. 90% of that income they will distribute to you. So it'll work like that. You will of course pay on your tax on that income, just like you pay tax on any other income. So that's one part. So capital gains is taxed at REIT level, 20% long-term capital gains, and the unit holders do not pay further tax. So capital gains, the part, if there is an appreciation in the value of the property, that capital gain will be taxed at the REIT level. You will not pay the capital gain side. So basically it appears that if it is basically income, then the income itself, the tax element is borne by the investor. As far as the capital gains side is concerned, there the long-term capital gain tax is paid by the REIT itself. In fact, this is one of the reasons, now that there is some clarity on this, we know who pays what tax and there is no double taxation. This is one of the reasons why this is starting to become not popular, but at least you have three companies which are providing, let's say, this particular type of fund, and where people can invest. So this particular thing, so think of it like this: assuming a rental yield of 10% and an increase in rent of 5% per annum, what is the money you will make? I'm trying to give you an idea of that. So tax will take away 3%, maintenance approximately 1%. So REIT will give a 6% return, which is growing at 5% per annum. So basically, this is the sort of return which you can expect. You will start off at 6, but it will begin to grow. And then, plus there will be NAV appreciation due to increase in the value of the property of approximately 5% per annum. So basically what you're getting is, you're getting this 6%, which itself is going to increase by 5% every year. Apart from that, you're also getting an increase in your NAV because of capital appreciation, which is approximately 5% per annum. So your total return is basically this 6 here plus this 5 here, which is about 11 to 12% return after tax. This is what you can hope to get in a REIT. See, the thing is now that these particular new alternate ways of investment continue to remain secondary means of investment. They are not, let's say, something which investors understand very well, which investors are used to doing, they're not comfortable with it. So maybe because of that, it is, like certain good ways of earning more than my bank fixed deposit. We are not actually exploiting that. That's my one understanding. Any comments, Pareshji, about this? Okay. See, this is the screenshot which I wanted to show you. So if you look at this was taken about roughly 2 years ago, 24th of November. The NAV used to be around between 300 and 350. It went up. This is basically 2020, yeah? This whole year. The year 2020, in that year you can see this. So somewhere around maybe January, it was somewhere here. It increased. by the mid-year, it was somewhere here. By mid-year, it had gone up to beyond 400. It was touching 450, let's say about August or September. Dropped again to just above 300 in about October probably. And it ended the year with, at this point, which is roughly 341. So this on 24th November 2020, it was 341. If you were to go to I think you'll find this on Money Control probably, and you look at these different periods, 1 day, 5 day, 1 month, 6 months, just like we had seen when we were looking at different mutual funds, you will also see when if you do these things, what exactly is the return that this particular REIT has given. You can see the name of the REIT. It is Embassy Office Parks REIT. So any REIT will have this particular the word REIT written in the company's name itself. So any questions, Shruti?
No, sir.
You're clear about this? So will you invest in it or not?
But I think, sir, it's very recently introduced in India. This concept.
19. It started in about
2019.
2019. 19.
Then lockdown and demonetization. So we have to wait before investment.
Very, very conservative person, Paresh. Okay. No, but you know what I feel is that we should diversify a little. You know, it is possible to put some money here, some money there, some in one type of mutual fund, some in this type of a mutual fund. It works just like a mutual fund. The only thing is that it is sector specific. So maybe when a mutual fund, it invests in different companies, those companies will be maybe working in different sectors. But here the entire investment is totally in real estate. If we normally accept that real estate properties actually appreciate and they do very well, if this is our view, then in that case, we should be okay with investing in the form of an REIT, logically. So if I feel that it is okay to invest in land, then there is no reason to feel that it is not okay to invest in REIT. Because basically this person is doing the same thing. The only difference is that there you are the owner of that particular plot of land or the flat or villa. Here what is happening is that you are the owner of a share, that's all, or a share in the company which actually owns the villa, that's all. To that extent, and see, the advantage is that you are not making a lump sum investment. You are making a smaller investment. And with that smaller investment, you are basically hoping that if there is genuine capital appreciation, your return is going to be much higher. So like in the slide before, where we were calculating the return, the assumption was that there will be a 5% increase per year. So if there is a 5% capital increase per year, in 10 years, it is saying that there will be a 50% increase. But it's very possible that if that commercial property is in a good location, the actual appreciation may be much more than 5%. And remember, every year there has to be a valuation of the property. And when the
so like mutual fund, we can see where they have invested the money.
Yes, absolutely.
Okay.
You will be able to see the entire portfolio, where they have invested, what they are doing. So you can do one thing, that you see where they invest and you go buy the next shop.
Right.
Something in the same building. So it will be like an index fund. So wherever the index is going, I am investing there. You look at where the REIT is going and you invest there. So that can also be a way. But you get the point I'm saying. See, when you look at these things, try to look at it completely. It is exactly, it is just like when we discuss gold, which is also an alternate asset fund. We'll discuss it next class. There again, we will see the same thing. Like if these people, when you invest in gold, it is not necessary that you invest physically in gold. You can invest through a gold ETF. So basically, you are holding a little certificate, which is a digital certificate which entitles you to possess a certain amount of gold. So this is just like that. You have a digital ownership of a certain amount of land. And when that land is sold, you get your share. When the land gives rent, you get your share. So in every case, it is exactly the same as land. So if I believe that there is a future in land and I am okay with investing in land, then logically, I should also be okay in investing here. So the only thing I need to understand is, are the promoters reliable? Have they done a good job in the past? And like Pareshji very nicely pointed out, where exactly are they investing right now? So these are some of the important things about this. So what is the place of real estate investment in your long-term wealth creation? If you look at this, one thing is very clear: you must aim to create some real estate cash flows before you reach financial freedom. Because if during your working life you are able to create, some real estate investment, this particular thing is going to help you a lot in the days to come. If you rely entirely on financial assets, maybe that can become very risky. Real estate that way will give you a greater stability. So, but remember, all these things, the benefits are to be reaped in the long run. So in any good investment, we need to remember that it has to be done over a long period of time. Only then does it work. So smartest people start investing in real estate before marriage. So Shruti and Tanya, for you people, this is a little hint here. So if you think you are smart, you will begin your investment before you get married. But you begin earning, that the process of investment starts right then. And in any case, it's my very, very strong view that people who get jobs they should actually try to begin saving rather as fast as is possible, because of the compounding element. The longer your money stays saved, the longer it is going to earn. So that basic principle is something which doesn't change no matter what the investment you actually choose. So that's one thing here. And start early, definitely. Do not aim for living in your own house early in life. Stay in a rented house. Buy a house when you're around 35 years old. This may not be possible for all of us, but at some point, I think this should be done. So in my case, I was never able to do it at this age. It happened close to this, but with a loan. If you are not doing mutual fund or stocks, then invest in real estate with a view to meet your passive income needs when you are around 40. A commercial property, REITs are the way to do it. What is this passive income here? Anyone?
Rent.
Passive income, Pareshji? Okay. Yes, rent. So basically, any income which your asset gives you, simply because you are the owner of that asset. So since you are the owner of equity, you get dividend, passive income. Since you are the owner of the FD, you will get an interest. That is again passive income. Since you are the owner of real estate or property, you are getting rent, passive income again. So if you are not investing in mutual fund or stocks, invest in real estate. I would say that even if you are investing in mutual fund or stocks, there is no harm in at least going for a REIT and having some exposure to real estate, but maybe not going the full way and putting a huge amount of money in real estate and then beginning to find it is problematic. The last thing here which we need to look at is the Real Estate Regulation Act, or RERA. You, of course, Paresh, you have heard of this?
Yes, sir. Yes.
Shruti?
No, sir.
Basically, you have a regulator in most industries. In India, one of the industries which needed regulation the most and which did not have a regulator was real estate. So here, as you can see, vested interest in real estate delayed the formation of a regulator for decades. They would not allow a regulator, and we all know this, that the people who actually are active in this real estate segment, in the builders segment, they are very influential people in every way. So they made sure that this law, the RERA, was not passed for decades. It's only now that it's happened. So India's stock markets were open to foreign investors in 1991. And SEBI was vested with powers to regulate insider trading the same year. So 1991 itself, SEBI is regulating stock markets. Telecom is getting regulated since 1997. Insurance regulation has happened in 1999. But RERA is something which comes only in 2018 or 19. So 20 years after these guys, then RERA comes. Even so, insurance, stock markets, all these things are getting regulated before. Real estate, which is something which is, let's say, affects each and every person in the country. Here we avoided regulation for 20 years after. Regulation should have been much before. So the size of India's insurance market is currently 60 billion. This is not current actually. The telecom market is about 30 billion. So even if you take this figure, you're talking about 100 billion. The real estate generates twice as much as both these. If you look at real estate, it generates twice as much as insurance and telecom put together. And despite that, entire amount of money flowing in and out of this sector, despite that, we did not have regulation for this. So that's one thing to think about, how things work in the country. Real Estate Regulatory Authority, RERA, this comes into being. Any real estate project which is where the land is 500 square meters or which proposes to build and sell any apartment, they have to register themselves for RERA. So the assumption is something smaller than this will be a family affair or an individual affair. So their a registration is not required. The other part is that builders will have to quote prices based on carpet area and not super built up area. So basically what happens is that the super built up area is the complete area taken from the outside. And to that, some common areas are also added. So if they begin to quote on that basis, the price naturally goes up because the super built up area is much, much more than the carpet area. But from the point of view of the retail investor or buyer, a person who wants to actually buy the flat, the super built up area concept is not very easy to understand. It is very easy to understand carpet area. So he is able to compare exactly what he is getting. Otherwise, the builder is in a position to fool you. In a super built up area, he adds all sorts of stuff, increases it. So you say that, okay, you have to consider taking a charge for the super built up area, but you add it to the carpet area and let us now look at exactly what you are giving. So every builder, if they are quoting on the basis of carpet area, it becomes easy for an investor to compare prices because carpet area is something which everybody understands. Are you getting my point here? Shruti particularly? Okay. Next point. 70% of the money which is received from customers by the builder has to be deposited in bank accounts through checks and used only for that specific project. So two things are coming here. 70% of the money received from customers has to be deposited in bank accounts through checks so that black money payment will get restricted, number one. And it has to be used for the specific project. This is another huge problem in this sector. They take money in the name of one project and then it tends to be diverted into some other project. So that again creates a problem. So the penalty in case of delay, let's say there's a construction delay, the penalty in case of delay by either the developer or the customer attracts the same penal interest rate of SBI, the MCLR, or the rate for medium, the lending rate for, let's say, I'm forgetting the exact. You simply take it like this, that this is a benchmark rate which SBI comes up with. And basically, the penal interest rate will be this rate plus 2%. So the lending rate of RBI, of SBI plus 2% will be the rate at which a penalty will have to be paid by the developer if he delays in the delivery of the project. So the builder also has a incentive to pay, to sort of make sure that the building is built on time, because they have been known, very famous for their for the delays that they create. Any changes in the project configuration, they come out with a plan, then they change it, has to get the clearance of 2/3 of the allottees. Everybody who was allotted the land previously, all of them, 2/3 of them, plus the RERA authorities, plus the government, that means all of them have to agree. So it is not possible for the builder to just go to the RERA authorities and there some underhand dealings are there and the plan is changed. It also has to be vetted by 2/3 of the allottees. If this is not done, the project configuration cannot be changed. So you can see how the consumer interests are being protected here. So developers have a liability of quality of construction and structural defects for 5 years. So for 5 years, once again, they have to make sure that everything is okay. If any defects come up during those 5 years, then once again, they are liable to fix it. They have to make sure that those things are fixed up. So these are features which are very, very, very important. And it's good for, it's led to higher governance and transparency. There's been a regulation of the environment. It's also resulted in a consolidation of the industry. And there is a higher institutional funding. So I think we will stop this particular thing here. I've given you a broad overview of how real estate works, what are the advantages and disadvantages of investing in real estate in India. So I hope this has been useful for you. Next week, we will get into the remaining part of alternate asset classes, which is basically gold. We'll do that part and then move on to a different unit. So is that okay? I think I can end it here today, if that's okay.
Yes, fine.
Okay. Thank you so much.
Thank you.
Thank